Good morning, friends and family, faculty, and administration. My name is Natalie Hogan, and today I want to talk about the central bank that has become America's most clandestine liability. With unprecedented power, the Federal Reserve controls national monetary policy and threatens to destroy the United States economy. As Thomas Jefferson, the third President of the United States, once said, "If the American people allow private banks to control the issuance of their currency, first by inflation and then by deflation, their children will wake up homeless on the continent their fathers conquered." Despite the warning of one of America's most respected founding fathers, Congress established the Federal Reserve in 1913, which controls national finance while also functioning as a private bank. By implementing short-term solutions, the Fed plants the seeds for long-term decline. Currently, insurmountable debt and inflation threaten to destroy the nation, and as the national monetary agency, the Federal Reserve is largely responsible. And if Congress fails to modify the Fed's policies, an economic collapse is inevitable. Thus, the United States Congress should abolish the Federal Reserve System because the Federal Reserve lacks oversight, implements inflationary policies, and encourages financial irresponsibility. But first, there are some essential definitions concerning the Federal Reserve. A central bank is a government agency that regulates the national currency and its value in foreign markets and monitors the credit supply, the reserve deposits of other banks, and the buying and selling of government securities. Also, an audit is an examination and verification of a company's books and records, and generally the GAO, or Government Accountability Office, is the investigative arm of Congress that is responsible for auditing government agencies. In addition, inflation is an increase in prices and a decline in purchasing power, and liability refers to a debt that must be paid or an obligation that must be met. And finally, liquidity support is money in the form of cash. Despite the failures of the three central banks in America's history, elite bankers collaborated in 1913 to create an even more unbridled banking institution known as the Federal Reserve. Shortly after the American Revolution, Treasury Secretary Alexander Hamilton urged Congress to establish the First Bank of the United States, or First BUS, in 1791. But 20 years later, Congress refused to renew its charter because Americans insisted that it had gained too much power. Then, in 1816, debt and inflation from the War of 1812 led to the establishment of the Second Bank of the United States. But many people viewed it as a threat to freedom and democracy, and President Andrew Jackson allowed its charter to expire in 1836. In 1863, the National Banking Act established a national currency backed by U.S. government securities, which are debt obligations of the U.S. government. But the currency was tied to the bond market, enabling an easy manipulation of the money supply. Financial instability ensued. Panics, or bank runs, occurred most notably in 1893 and 1907, and the solution to financial chaos was supposedly found in the Federal Reserve, even though it was government regulation that had caused the banking panics, not the free market system. In 1913, President Woodrow Wilson signed the Federal Reserve Act into law, and the system consists of a board of 7 governors in D.C. and 12 regional banks, in which national banks are required to own stock and member banks can choose to own stock. Moreover, it is based on Keynesian economics, which asserts that governments should spend now and pay later to stimulate the economy, but the logical outcome is debt and decline. In addition, the Fed has continued to expand its initial delegation of power, which was already unprecedented and unconstitutional. In 1935, the Fed created the Federal Open Market Committee, or FOMC hereafter, which pretty much sets monetary policy for the nation without any oversight. Then in 1971, President Richard Nixon abandoned the gold standard for a pure fiat money system, meaning that paper money is backed solely by the government who issues it. This system has furthered inflation, as evidenced by the 83% devaluation of the dollar since 1971. And the Fed's policies overpower the self-regulating free market, as in the creation of the business cycle, in which a boom, or a time of illusory prosperity, precedes a bust, which is a correction of the inflated supply through a recession. Also, the Fed operates against biblical principles of financial responsibility. Proverbs 21:20 states, "The wise man saves for the future, but the foolish man spends whatever he gets." Under Keynesian economics, the Federal Reserve not only spends whatever it gets, but it also spends what it doesn't even have. In Psalm 8:6, David praises God, saying, "You have made people rulers over the works of your hands. You put everything under their feet." As God's representatives on earth, humans are to be responsible, whereas the Fed encourages financial irresponsibility. First of all, Congress should abolish the Federal Reserve because it lacks oversight. Supporters of the Fed's minimal accountability assert that if Congress fully reviewed Fed policy, the Fed would lose independence from political pressure, and congressmen could suggest corrupt policies to create illusory wealth to help them get reelected. In direct contrast, the Constitution explicitly gives Congress the sole power over fiscal matters in Article 1, Section 8. Also, the opposing view actually confirms the Fed's need of accountability, for the Federal Reserve is no less susceptible to power corruption than Congress. If congressmen could distort policy for their own re-election purposes, is it not possible that the Federal Reserve could also distort policy for personal gain? A strong system of accountability needs to be in place between the Fed and Congress, because the Fed's little accountability allows unhindered fraud. Finally, being checked for honesty and wisdom in its procedures could hardly subject the Fed to political pressure. Often, if an institution can be created without proper authority, it can continue without proper authority. Such is the story of the Federal Reserve. Around 10 p.m. in 1910, 7 men quietly boarded Senator Nelson Aldrich's railroad car, headed for Jekyll Island in Georgia. Representing about 1/4 of the world's total wealth, these men set out to create, as Senator Aldrich said himself, quote, "Not a bank, but a cooperative union of all the banks of the country for definite purposes. Such a union would prevent competition among banks and would be rejected by a free market society. So, the meeting had to be kept secret." Directed to use first names only, these men pretended to be going on a duck shoot, which was funny because many of them had never shot a gun before, no less a duck. As Frank Vanderlip, one of the Secret Seven, later wrote in the Saturday Evening Post, "If it were to be exposed publicly that our particular group had gotten together and written a banking bill, that bill would have no chance of passage whatsoever by Congress." Born in secrecy with questionable intentions, the Fed has continued with insufficient oversight. For example, it is largely unanswerable to Congress. The GAO, or Government Accountability Office, is strictly limited in its audits of the Reserve Banks and Board of Governors. The GAO law exempts transactions within foreign central banks, decisions on monetary matters, Federal Open Market Committee transactions, and communication within the Federal Reserve System. Moreover, these are just category titles for the prohibited material. For example, decisions on monetary matters include reserve ratio requirements, open market operations, interest rates, and lending operations, all of which have subcategories. These are some of the Fed's most influential policies, and they are essentially free from accountability. Also, the Fed claims to be within government, so it can control national finances. But, as former Fed Chairman Alan Greenspan once stated, the Fed's independence, quote, "means basically that there is no other agency of government, including the executive office, which can overrule actions that we take," end quote. This lack of accountability has paved the way for extreme corruption. The one partial audit of the Fed's lending activities showed that between 2008 and 2012, the Fed secretly lent $16 trillion to U.S. and foreign banks, which is about $1.5 trillion more than the U.S. gross domestic product, or GDP. Also, House Representative Alan Grayson questioned the Inspector General of the Federal Reserve about $9 trillion in the Fed's off-balance sheet transactions. But the Inspector General did not know where the money had gone or what losses the Fed was incurring. In addition, the Fed prints money without sufficient cost, loans it to the government, and charges interest, when Section 16 of the Federal Reserve Act explicitly says that the Fed should be paying the government interest to use the Treasury printing facilities. Furthermore, after signing the Federal Reserve Act into law, President Woodrow Wilson stated, "I have unwittingly ruined my country. The growth of the nation, therefore, and all our activities are in the hands of a few men." This centralization is shown in the Fed's protection of its own stockholders. Gunther Russbacher, who extensively studied American banking as a CIA agent, discovered that the big banks arranging the bank takeovers get advantages through their stock holdings in the Federal Reserve. For example, the Fed rescued investment bank Bear Stearns in 2008 with approximately $29 billion in support. Indirectly, however, the Fed was bailing out its own stockholder, J.P. Morgan Chase, which had a lot of stock in Bear Stearns. Finally, World Bank insider Karen Hughes said that the power grabbers at the Fed have been linked with inaccurate bank statements to the World Bank and have created an interlocking network of support to hide the corruption. Undoubtedly, this corruption and lack of accountability have directly contradicted Scripture's commands of faithful finance. Luke 16:10 explains, "Whoever can be trusted with very little can also be trusted with much, and whoever is dishonest with very little will also be dishonest with much." Since people do not even know the extent to which the Fed has been dishonest, it would be foolish to continue to let the Fed control the U.S. financial system. In addition, Congress should abolish the Federal Reserve because it implements inflationary policies. Supporters of the Fed's inflation argue that moderate inflation is necessary to stimulate the economy. When the government increases the money supply, individuals have more money so they can spend more. In turn, local businesses prosper and the owners have more money to spend. The idea is that the cycle will continue and inflation will jumpstart the economy. However, no true value is really added because the value of the money supply is just diluted. In other words, people need more dollars to buy the same amount of goods. And there may be a temporary economic boom, but a bust will inevitably follow as a correction of the false expansion of credit. Moreover, inflation has not been moderate, as the dollar has been devalued by 96% since 1913. The Fed operates with fractional reserve banking policies, meaning that only a percentage of the deposits need to be kept in the vault. Effective as of January 23, 2014, banks are not required to hold any percentage of their liabilities between $0 and $13.3 million. Similarly, banks only have to hold 3% of their liabilities beyond $13.3 million and up to $89 million, and 10% of liabilities beyond $89 million. If people were to engage in a widespread banking withdrawal, the money would not be immediately available and economic turmoil would ensue. When lending occurs, banks continually record fractions of the same deposit, which can result in a $15 million deposit appearing to be $500 million, thus creating $485 million in illusory wealth. If people became aware of the extent to which reserves are underfunded, they will lose confidence in the system and start a run on the banks. Although the Federal Deposit Insurance Corporation, or FDIC hereafter, promises to cover $250,000 of each account, it also is underfunded, and the Fed would just print money to cover the difference, causing more inflation. Also, the Fed contributes to inflation through its open market operations, or OMOs, which include the buying and selling of government securities, or debt obligations of the U.S. government. As of August 2013, the Fed owns a record high of $2 trillion in Treasury securities, meaning that it created money from nothing to buy government debt. On top of that, the Fed is currently creating $75 billion each month to buy more securities. This amount of unbridled inflation is unacceptable. In addition, the Fed's interest rates lead to inflation because low interest rates encourage borrowing, resulting in more fractional reserve banking and thus more inflation. Currently, the rates are historically low, which is creating an unsustainable illusion of wealth. Moreover, the Fed's interest rates fixtures can smother market indicators and lead to malinvestments, because lower rates should indicate savings to back the money being lent, when in reality, the Fed is using the low rate to expand the money supply. Inflation causes numerous problems that threaten the U.S. economy. First of all, the booms brought about by the extension of credit prolong the inevitable correction and deepen the bust. Also, trade partners could refuse to accept the currency, which would cause hyperinflation, as foreign countries would send billions of worthless dollars back to the U.S., and already several countries have expressed similar desires. In one such example, Russian Prime Minister Vladimir Putin suggested to Chinese leaders that their countries stop using US dollars in Russian-Chinese settlements. In addition, inflation redistributes wealth, but often by pulling money from the middle class. The people who receive the money first, namely the bankers, benefit most because they have more money, but prices haven't risen yet. Meanwhile, people with fixed wages, including teachers, pastors, and those living on pensions, are the most adversely affected because they receive the same number of dollars, but the money has real less value because of inflation. The Bible forbids such monetary debasement, as God himself emphatically states in Leviticus 19:35-36. Do not use dishonest standards when measuring length, weight, or quantity. Use honest scales and honest weights. In Bible times, dishonest measure could be achieved by mixing the currency with inferior metals, which is equivalent to the Fed diluting the currency by just printing more money. Also, Isaiah rebukes Israel in Isaiah 1:22, saying, "Your silver has become dross, your choice wine is diluted with water." Israel had weakened the value of a unit of silver by mixing it with dross, which is baser metals like copper and iron. When the Fed prints money, it also weakens the value of a dollar. Thus, the Fed's inflationary policies must be severely diminished as they devalue the currency, promote financial uncertainty, redistribute wealth, and lead America toward further debt and decline. Finally, Congress should abolish the Federal Reserve System because it encourages financial irresponsibility. Supporters of the Fed's bailout policies argue that if the Fed allows a bank to fail, depositors will be deprived of money. Also, they say some banks are too big to fail, meaning that if the Fed allowed them to fail, chaos would overwhelm the national economy. However, banks become too big to fail when the Fed promises to assume their risk while they engage in irresponsible policies. And by continuing to bail them out, the Fed perpetuates banks that are too big to fail. Also, in a competitive system, deposits that remain unpaid would go to court under fraud laws against the insolvent banks. And the Fed just giving money does not fix the inefficiency that caused the insolvency. So sometimes the Fed is financing banks that are permanently insolvent. So increased inflation, decreased tax reserves, and no substantial benefits are attained. By promising to protect the banking system against failure, the Fed violates a fundamental principle of banking and insurance by creating moral hazard, which by definition encourages financial irresponsibility. Essentially, moral hazard means that people are more willing to take more irresponsible risks when they do not have to assume the cost if the venture fails. The Fed has implemented moral hazard by shifting the risk from the banks to the people, who pay for bank losses through taxes and inflation. Ironically, insurance in general creates a little moral hazard by reducing individuals' risks. But it is more serious when the Fed creates large-scale risk in the entire national economy. For example, the Fed conducts numerous discount window operations, in which the Fed gives direct loans to banks that need more money in their reserves. Often, the Fed offers subsidized credit, meaning that the Fed loses money when the long-term cost of the loan is considered, because the interest rates are way too low. For example, a 1991 House banking report said that the Fed provided subsidized credit to banks that were insolvent, as proven when 530 of the 3,000 banks that had drawn from the window within a 6-year span failed shortly thereafter, and many of the other banks had very low performance ratings. In addition, the Fed's function as the lender of last resort contributes to financial irresponsibility because people know that the Fed will bail them out if they engage in irresponsible investments. To illustrate, Fannie Mae and Freddie Mac had government-guaranteed liabilities, so they engaged in irresponsible lending, and then the Fed assumed $1.3 trillion in mortgage-backed securities. Also, the Fed issued a $29 billion bailout for Bear Stearns, which was taken over by J.P. Morgan Chase, even though Bear Stearns had been poorly managed with highly leveraged. Shortly thereafter, the Fed gave over $130 billion in support for the takeover of the American International Group, or AIG, which was also poorly managed with careless policies. Finally, the Fed backstops the FDIC, which, as Franklin Roosevelt accurately stated, would place a premium on unsound banking and involve the government in probable loss. Banks have to belong to the FDIC, meaning that they pay into the funds so that their deposits are insured. But in case of any major bank failure, the Fed would just print money to cover the losses, so the people would pay for the failure through inflation and taxes. Shifting the responsibility from the banks to the people, the Fed creates financial irresponsibility. Bailouts reward inefficiency and discourage competition. What incentive do banks have to make sound investments if their competitors issue irresponsible loans and make higher profits because they receive the Fed's liquidity support? In addition, the Fed's liquidity support deteriorates the standard of living. With moral hazard, banks across the nation are not operating as wisely as they could. So, more bank failures, more liquidity support, more inflation, and a perpetual downward spiral as the national economy declines. Scripture also discourages such a system. In Exodus 20:15, the 8th commandment states, "You shall not steal," which the Fed has broken numerous times, for inflation is a form of stealing from the people. Similarly, the parable of the talents in Matthew 25:14-30 shows the importance of responsible investments. The 2 servants who responsibly invested were commended, but the 3rd servant, who failed to wisely invest, was condemned for his laziness and irresponsibility. The Fed has also failed to encourage responsible investments. Instead, the liquidity support provided by the Federal Reserve not only promotes inefficiency and encourages financial irresponsibility, but also violates biblical commands. In order to retain the integrity of America's economy, the United States Congress needs to first reform and then dissolve the agency that is largely responsible for devastating the national economy. After 20 years of reform, Congress is to transform the Federal Reserve into a committee within Congress that has strictly limited central power. To begin these reforms, Congress must require true full audits of the Federal Reserve to determine the scope of its deception and corruption. Both the GAO and an independent outside auditor must conduct a full audit of the Federal Reserve annually. At FOMC meetings, a Republican and Democratic senator and representative must be present, and they must be educated in monetary matters and report directly to their respective congressional chambers. In addition, Congress needs to gradually curtail inflation. The Fed is to have a minimum reserve ratio of 30%, which can be achieved by raising the ratio 2.3% for 10 years. This 30% rate is used in Lebanon and has helped to establish their sound banking structure. The Fed also needs to end its quantitative easing policy of printing $75 billion monthly. By printing $1 billion less each month, the program will be successfully ended in 6 years and 3 months. Finally, the Fed must reduce financial irresponsibility and moral hazard. The Fed must raise the discount window rate by 1.1% for 5 years to reach 6.75%, which will reduce subsidized credit and discourage easy borrowing. Banks will no longer be forced to join the FDIC, and Congress should encourage banks to purchase their own privatized insurance because after 20 years, the Fed and the FDIC will no longer provide insurance. In other words, banks will not have the FDIC's publicly insured deposits, but rather banks will purchase private deposit insurance. After 20 years of gradual correction and recovery, Congress should change the Federal Reserve from a private bank that handles national finances to a standing committee within Congress that is a legislative panel subject to congressional oversight and limited in central economic planning. Banks will operate under a more free market system, purchasing privatized insurance and setting their own reserve ratios. With increased accountability, true records will be ready for Congress. With reduced inflation, illusory wealth will be successfully corrected. With competitive insurance, banks will be more financially responsible as moral hazard will decrease. Thus, the transformation will not cause major shockwaves because the reforms will have paved the way for the transformation. In the initial years of reform, there may be some ramifications that are perceived as very serious, but in reality, they lead to long-term benefits. First of all, there may be a recession as the money supply tightens to correct the illusory wealth. But with gradual correction, the depth of the recession won't be as severe, and it will resolve the underlying issues and promote long-term prosperity, which is better than the current unending recessions that only further economic decline. Also, banks may fail since they are used to receiving liquidity support. But this is actually better for the economy because it promotes responsible policies and ensures that neither taxpayer dollars nor newly printed money will fund an inefficient, insolvent bank. Finally, tighter credit may make banks more selective in their lending policies, but it will force individuals and government to handle finances more responsibly. As the nation's monetary policy maker, amidst economic turmoil, the Federal Reserve must be reformed and then abolished to promote America's long-term prosperity. Shielded by law and the complacency of Congress, the Federal Reserve has escaped accountability and has continued unhindered in secretive operations. Through fractional reserve banking and open market operations, the Federal Reserve has stifled free market principles and devalued the currency. By promising to protect banks against failure, the Fed has encouraged high-risk investments and established moral hazard in the national banking system. The Federal Reserve is destroying the national economy and seeding economic chaos in America's future. To preserve both personal and financial freedoms, the American people should heed Thomas Jefferson's advice and reduce the unprecedented power of the Federal Reserve. Time is running out and debt is climbing up. To refuse dissolution is to condemn future and present generations of Americans to exploitation by America's most clandestine liability, the Federal Reserve.